Good afternoon, everybody. It is Jeannie Fisher, a Senior 401k Advisor and Certified Financial Planner with Argy Investment Services. And today we're going to continue with that basic investing series that I started last week. And last week I focused on the things that you actually invest in, like stocks and bonds and mutual funds. And we're going to go really basic again today and just talk about types of accounts. I think new investors can kind of confuse the two. So I wanted to break down what types of accounts are there out there, when do you open them, and why do you open them? Now, we can break this down into two basic categories first. There are non-qualified accounts and qualified accounts, and there can be some differences in between the two, but think of it as a qualified account qualifies for preferential tax treatment. Okay, non-qualified accounts don't. And the types of non-qualified accounts that you're used to are your checking and savings account. Okay, this is the type of account. It is, for lack of a better example, think of it as the vehicle, as the car that holds the investments. So you have a checking account, and the passengers in that checking account are typically cash. Okay? Another example of a non-qualified account is a brokerage account, a non-qualified brokerage account. And again, you have the account, and inside the account you hold the passengers or the investments. And the big difference between a checking account and a brokerage account is that a brokerage account is with a brokerage firm, which would allow you to buy or sell securities or things of that like. Now, when deciding whether to open a checking account versus a brokerage account, you really want to think about your time horizon. Checking and savings accounts hold cash and liquid investments that we use for emergencies, anything that you're going to need in the short term. Your brokerage accounts, generally speaking, you're looking for a little bit longer of a time horizon. While they are accessible, they're not nearly as accessible or liquid as a checking account. So think of that as something that's going to be a little bit more long-term of an investment. Now, these non-qualified accounts don't qualify for preferential tax treatment. So because of that, there's no limitations on who can contribute. There's no limitations on how much you can contribute. There's no restrictions on getting that money in and out. They're very, very flexible. Gains inside the account may be taxable as capital gains, and interest and dividends thrown off would be taxable as ordinary income. Okay? Now, the other type of account that most of you are probably advised to start investing in first is a qualified account. And we can break that down into two broad categories. You can have your individual retirement accounts, and you can have employer-sponsored plans. So let's focus on the individual retirement accounts first, often called the IRA. And there's two types. There's the IRA and the Roth IRA. Now, the difference between these two is that they're taxed differently. They both get preferential tax treatment, but they are taxed differently. Now, crash course that one really quickly. The traditional IRA, the money you put into that account may be tax deductible, and it will grow tax deferred, meaning that as interest and dividends are thrown off, or if you do any trading inside of the account and a gain is realized, none of that is taxable. However, when you go to take the money out of the IRA, it will all be taxed as ordinary income. Now, the Roth IRA is a little bit different. You won't qualify for a tax deduction when you contribute the money, but the money will grow tax-free, just like the traditional IRA. Interest won't be taxed. If you buy or sell investments at a gain, those won't be taxed. But even better, if you follow all of the rules, when you go to take the money from the account, it will actually be withdrawn tax-free. Money contributed and growth. Now, I have a video on why we should all be considering the Roth, but what I want you to walk away from here with is the IRA and the Roth IRA are qualified accounts and to a certain degree qualify for preferential tax treatment. Because they do, there are limitations. There are limitations on who is eligible to contribute. There are limitations on how much you can contribute. And there's even limitations on when you can access the money. So you want to be very cognizant of when you should be using an IRA or a Roth IRA. Now, the other type of qualified account that's really common are employer-sponsored plans. And here's when all these fours start rolling in. 401k, 403b, 457. These are plans that you contribute through your employer and through your paycheck. So if you want to contribute to an IRA or Roth IRA, you could do a direct withdrawal from your bank account, but you don't contribute from your paycheck. The employer-sponsored plans you do. Now, inside those employer-sponsored plans, you can have the same thing. You can have the traditional deferred. You could have a Roth 401k. You still have options on how you want the accounts taxed for the most part, if your plan allows it. But again, a qualified account, only this time hosted through your employer. Now, the interesting thing about these employer-sponsored accounts is same idea. There are limitations on who can contribute, how much you can contribute, when you can access the funds. all sorts of rules you want to be aware of, but they do tend to be a little bit more lenient than the IRA or the Roth IRA. So a good example of that is many people may be above the income limitation when it comes to being eligible for the Roth IRA. However, the Roth 401k does not have an income limitation, meaning that many more people are eligible for that type of account. So when we break down the types of accounts, one of the things you want to ask yourself is, I know I want to start saving, I know I want to start investing, I have to open some type of an account, where should I start? And the first thing you want to look at is, what is your goal for the account? What is your goal time horizon? If this is for something in the near term, if this is for emergencies, if you need the money to be accessible to you, you're probably looking at a type of non-qualified account or a checking account or a savings account. But if you really want to take advantage of some great tax opportunities, you would want to consider a qualified account, whether it be the IRA or an employer-sponsored plan. And then you want to start asking yourselves things like, what do I want the goal of this money to be? When do I think I'll need it? What do I anticipate from my tax perspective? I can tell you each of them are going to have their own strengths. IRAs and Roth IRAs, because they're your individual accounts and you can control them, you may have some more flexibility in what you invest in. Whereas an employer-sponsored plan, you're basically just accessing a plan that is there. You don't have a whole lot of control over it. However, employer-sponsored plans tend to be pooled, and because of that, they may have access to economies of scale, and they may be more efficient or, in layman's terms, cheaper than if you were just to go open up an IRA account by yourself. Now remember, there's a lot of rules around when you can access these qualified accounts, but generally speaking, if you're going to start saving and you're looking at a long-term investment horizon and you already have your emergency savings set aside, one of the best places to look first would be these qualified accounts with these really good tax advantages in them. So hopefully that helps explain a little bit around what an account is and how we open accounts to hold investments. We're going to continue this theme with the individual investor throughout the weeks. We have a lot to talk about and a lot to expand on, but this should at least get you to the basics. What do we invest in and what kind of account do we open up? Thank you guys so much. I hope you all have a wonderful week and we'll talk to you soon.